Gold thumbs up, but silver 2 thumbs up because it's going to beat gold. We're only a fourfold move. Again, that low was 1,050. We're $4,000. Okay, you go to 8,000 plus, and then you could at least say, oh, gold matched its prior old bull markets in terms of ratio scale. That's not a target on our part. That's just pointing out a feature that people just are not aware of. I think we'll go well beyond 8,000.
Silver will do really well as well, of course, if we see this doubling again in the very near future. And so if you take 8,000, if we go to 50 to 1, that would mean silver at 160. Even if silver doesn't really, well, it will outperform in my opinion, but let's say it just goes down to 70 to 1. Well, that's still $115 silver before the end of the year or in the beginning of next year. And it could be a lot more.
Gold continues to consolidate within a strong bullish structure, holding firm above $4,000, even as volatility shakes out weak hands. The market has absorbed a historic rally, cooled sentiment, and now sits inside a tightening triangle formation that often precedes a renewed surge. With support repeatedly building just above $4,000, the broader trend shows no signs of exhaustion, only preparation for the next move. Marioinnecco, a longtime monetary historian, and Michaeloliver, one of the most respected momentum analysts in the precious metals space, note that the setup resembles previous periods when gold transitioned from a steady advance into an accelerated phase. Their technical readings point toward gold pushing quickly through $4,400 and entering a powerful expansion cycle that could lift prices toward $5,000 to $6,000 in early 2026, and potentially $8,000 or higher if long-term momentum ignites. Silver mirrors this dynamic with a new teacup formation sitting directly on top of its 45-year breakout, supporting projections of a rise toward $53, then $100, and, under a 50 to 1 gold-silver ratio, targets of $115 to $160. With macro stress rising and monetary confidence eroding, both metals appear positioned for another explosive leg higher. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
This year, 2025 is shocked people. People didn't expect gold to have gone up so quickly. Aside from the consolidation period we had from like April to August, gold has been going up in a straight line, and it's gone from, let's say, 2,600 beginning of the year, and right now we're at above 4,000. And as I said, we're at almost 4,400, and we only really broke that 2070 high definitively. That started in March of 2024. So it has been, it's going to be a couple of years very soon, come the new year. But as he said, it's accelerating. And I have this long-term chart here that I've shown you a few times. And you can see the break that we had last year of like 2,700, which is corresponds to a really long-term trend line. Since then, gold has taken off. It's this acceleration that he's talking about, the Nome of Zurich, that is. And the thing about these accelerations is that if you don't look at the markets really long-term, like he does, going back even a couple of hundred years, and you can look at it, you don't know in which cycle or which Elliott wave cycle it is, or which wave, and that's why he thinks it's going to accelerate a lot. And we could, so he's looking for that doubling. It could be very soon. It could be even before Christmas, could be after Christmas. Yeah, the markets and nature and the seasons, they're not perfect things. Generally, they happen at the same time, but it's very hard to predict with exactitude. But yeah, so that's what he's seeing. Surprise on the upside. Yes, right now we've been actually in a choppy consolidation since that top. And I've actually looked at the charts in gold, and I'm going to talk a little bit about them here, more of a short-term chart. I'm going to bring it up so you can see it. Yes, from the top in October, we have now formed like a triangle, and gold is trading within this triangle. And the apex, the end of the triangle, the top of the triangle, which is the place by which the market should have decided either to go up or down. And usually in a bullish triangle like this, 3 out of 4 times the market goes back to the previous trend, which was up, of course, prior to the consolidation. So yeah, you can see here there's a really nice triangle. And right now, let's say today, that would be around 4,200. Right now, as I speak here, it's 8:15 a.m. London time. Gold just dropped about $20 since I started this video or recording, which has been normal the last few weeks. We're seeing a lot of choppiness. But yeah, and on the downside, this triangle, we've got support just above 4,000. So I would expect it to hold 4,000. We had been at 4,038 overnight. The high overnight as well as 41,100. So yeah, maybe once we break on the upside of this triangle, we could resume a lot higher. I still think the signal, of course, is that we are on a new bull leg, short-term bull leg, when we break the previous high, just below 4,400. That's always the easy way to know. And silver as well. I've looked at silver, and there's a very interesting formation in silver. It's another teacup and handle, a very tiny one, because on the daily chart, it's from the high in October, mid-October, when silver traded to a record of 54.60. And you could make it into a triangle as well, but I think it's appropriate to call it a teacup, because looking back 45 years, we have that mother of all teacups, and now we have a little teacup evolving on the breakout of the handle of the 45-year formation. It's like a fractal. What about silver? Because I asked him about silver as well, and he told me that the silver market has a different cycle than gold, of course. Like kind of the low in silver since 2011 was not in 2015 but in 2020, but he said yeah, silver will do really well as well, of course, if we see this doubling again in the very near future. And so if you take 8,000, if we go to 50 to 1, that would mean silver at 160. Even if silver doesn't really, well, it will outperform in my opinion, but let's say it just goes down to 70 to 1. Well, that's still $115 silver before the end of the year or in the beginning of next year. And it could be a lot more. So the focus is on what gold has done. And the other thing I want to bring up, so yeah, this teacup, before I move on, is a bullish formation, of course. And right now, the top of the teacup is around 54.55, of course, which was the high. And we're still working on the handle. Yeah, I wanted to bring up a chart of gold, a weekly chart, back from the 70s and early 80s, because some people might think, oh, you're crazy. How can gold double in a month or two? Well, if you look at the 70s bull market and its conclusion in January of 1980, and that's the other thing, the gnome doesn't think this move that he thinks could happen is the last leg of the bull market, because we are in a different kind of cycle than the 70s and 80s. So anyway, but what happened in 79 is quite amazing, because if you look at this weekly chart from 1979 to like 82, you can see that gold was going up quite nicely since 1978. And I'm going to take the date of November 29th, because November 19th, the week of November 19th, which is pretty much the week that we're in now, but this is back in 79. Well, gold was trading, the high that week was 400, the low was 388. So it was trading around 400, below 400. And I guess that's the equivalent of 4,000, right? And then by January, the week of January 21st, 1980, it had topped, according to this trading view chart, it had topped at 873. So it more than doubled. So it's not impossible.
The precious metals market is entering a new phase, marked not by exhaustion, but by the early stages of a long-duration breakout. Gold's rise from the $1,050 lows to above $4,000 is only a fourfold move, far smaller than the eightfold expansion seen in previous secular bull cycles. Structural charts now show fresh breakouts against major equity benchmarks, signaling a broad asset class shift away from inflated stock valuations and into monetary metals. Silver is showing even stronger momentum, with the spread turning decisively higher for the first time in years, indicating leadership is rotating toward the metal that historically outperforms during the acceleration phase. With long-term bases resolving, spreads breaking decade-old ceilings, and momentum structures aligning across multiple timeframes, the data suggests the real move is only beginning. These signals point toward years of upside, not months of noise or short-term hesitation. Let's get back to the interview.
I think the game is just beginning. There's you look at the gold price chart anytime you want. You punch it up on your screen, see a weekly or monthly. So, my golly, that's huge. It's got to take a profit. Time to get out, et cetera. The gold trend is, there you go. Naturally you want to get out. If you go to my report, I'll show you a different version of this gold chart and compared to an arithmetic chart, which looks like it's gone ballistic. If you go back and when gold was legalized by the state in January 75, gold was then at 200. It had already gone in the cash markets from like $30 to 200. But anyway, then there was a bear market that took you down back to 100, cut in half. That was in 1976 summer. Between that low in the summer of 76 and 1980, 3.5 years, gold went up eightfold from price low to bull high. Okay, these are monthly closes, by the way. Now, then it went sideways at a high level, relative to prior history for 2 decades almost. Okay, and then in 2001, with a low at around $260, it surged the second time. And when it peaked in 2011, a longer bull market, but the same dimension, eightfold gain in price, bear low to bull high. Okay, and then it topped, and you had to drop back to $1,050 in 2015. And if you measure that as the bear low that, followed that high, we're only a fourfold move. Again, that low was 1,050. We're $4,000. Okay. You go to 8,000 plus, and then you could at least say, oh, gold matched its prior old bull markets in terms of ratio scale. That's not a target on our part. That's just pointing out a feature that people just are not aware of. I think we'll go well beyond 8,000. But anyway, the point being here, quit talking about gold being overdone. And then there's a more important chart, the one where really MSA looks at momentum and structure. But in this case, what we're looking at is simply price versus price, a spread chart. And back in 2013 in particular, gold was collapsing. Peaked in 2011, went sideways 2012, and really started to come apart in 13. Front month gold future, divide its price into the S&P, express it as a percent.
So anytime the chart goes down, it's the S&P outperforming gold.
And gold underperforming the S&P in this case. We could have flipped it the other way as well, but in which case you'd have a topping pattern as opposed to a bottoming pattern by gold. But anyway, you can see that since 2015, when gold made its bear low in price, that was when it was just above 50% there. It was right where gold price actually ended the downside. If you go sideways from there for 10 years, you've been either side of that level equally. Meaning, it depends on when you look at it, but gold's been par to the S&P. It's done just as well as the S&P with ebbs and flows, better times, worse times, but sideways. Now, but in that period of 10, 11 years, I count 1, 2, 3, 4 highs that define a gradually declining resistance line. We hit it back in April. That's when gold was surging in net price. That's when we hit it the last time there. That's April of this year. No, the other time. There they go. That's when gold was surging in price when the S&P was dropping 20%. That's not supposed to happen according to common wisdom. When the S&P gets kicked bad, gold should go down too, right? It's falsehood. Anyway, you did back off from there, and gold went sideways in price for 5 months. It hit 3,500 and just went dead. Constant selling, but no real sustainable downside gains for the bears. Now you're intra-month with a week to go in the month. You're at 61%. You close a month at 60% or higher, dividing December gold future into S&P, and that's a breakout. So what this chart is telling you is if this were a price chart and the average guy looked at it and say, oh boy, this is a major breakout, I got to buy this thing. Well, that's right. It's telling you that gold is, while it's been doing okay versus the S&P for a decade in real terms, up and down, but sideways, it's breaking out. This is just starting. This isn't some old game. It's just starting. That's a fresh breakout. Again, if this were a price chart and you saw that happening, you wouldn't say something's about to end. You'd say something's beginning. Okay. So what this is telling us is there's a major asset class shift out of especially the U.S. stock market bubble, which is probably the biggest one in the world. Many other markets don't have bubbles like we do. They're up like us, but not bubbles. Mm-hmm. And into monetary metals. We've already seen evidence of that. The last couple of years, gold's been doing well versus S&P, but it's only begun. We've just broken out of the massive base. So when this breaks out, it's likely to happen this month. All you do is hang around on the spread and it breaks out. This thing's going up for years. You don't have a base like this that go up for 2 months and then fail. This is a start of something. So it's an investment grade smack in the face. Reality's changing, guys. Something's going on. I'm not going any lower. Okay, this is a spread chart here versus silver versus gold, the top chart. Top chart's a spread chart. And it's week to week instead of month to month. And we go back to 2020. And back then, that's when silver and gold both surged into late 2020. And gold went up 40%, but silver doubled. Okay, so this spread went, ooh, wow, an explosive move in a handful of 6, 7, 8 months, okay, in terms of percent gain in price and percent gain on the relative basis. But then in late 2020 and early 2021, the spread peaked at 1.5% thereabouts and dropped. Now, silver also, like the miners back then, while gold went into a range for a couple of years, sideways range, up and down. Silver and the miners went into a more or less staircase decline. And it particularly shows on the spread chart. So while gold was sort of going lateral, they were sort of going staircase down. So the spread deteriorated. Now, during that time, silver was going up in net price. I mean, you can go back to, 2022, there was a low there at 1.05%, but, the spread's above there now. Recently, you'll notice since March, April of this year, which is when gold stalled, remember, at 3,500, the spread has exploded from what are historically very low levels for that spread. Getting under 1% is like, it ain't going free, okay? Right. You're buying something that's next to free. So silver shot up, and it's now, this is last week's close, marginally above a downtrend going back to 2021. But the better line in our assessment is that green line, the horizontal. Mm-hmm. And that line gets taken out. We're dividing these silver into these gold and expressing it as a percent. That's how you come up with this number. 1.32%. You ever see a weekly close of December silver versus these gold that puts the spread at 1.32, blows out that ceiling that goes back to 2022, 3-year ceiling, perfectly horizontal, very clear. Okay, but already it's taken out a trend line. Now, if you'll scroll to the chart below, it's momentum of that spread. Okay. What we do is we take those spread readings you saw above and plot them in their relationship to a 40-week moving average of the spread. 40-week average is almost like a 200-day line or a 3-quarter average. So is the spread above that average or below it? And you oscillate it accordingly. And notice that it's created the same horizontal structure. The only difference is we're at it. Momentum almost always leads price. So we're focused also on the momentum of the spread, because when it breaks out, that gives us a heads up. Expect the spread chart itself. Now, what does this mean? It means as gold enters a massive asset shift favoring itself versus stock market, Within the monetary metals, silver's about to shift into a leadership position. So yeah, gold thumbs up, but silver 2 thumbs up because it's going to beat gold.
Gold's advance is entering a powerful new phase as long-term structures finally resolve and fresh momentum pushes the metal into territory not seen in modern markets. The recent consolidation above $4,000 is not exhaustion, it is the early staging ground for the next explosive leg higher. Decade-long base formations against major equity indices are breaking decisively, signaling a rotation away from inflated financial assets and toward monetary anchors with no counterparty risk. Silver is confirming this shift through its own structural breakout, with spreads tightening from historically depressed levels and momentum indicators turning sharply upward. This dynamic positions silver to outperform in the next expansion cycle as ratio compression accelerates and multi-cycle patterns repeat. With both metals aligning in favor of sustained upside, the broader market environment is preparing for a dramatic repricing of tangible assets in the months ahead. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.